Do you know that you can invest in government securities that offer you higher interest rate? These are called state development loan bonds, which are issued by the state government to raise money for a specific project. They are slightly different from government securities in terms of risks and return. But the question is, what happens if the state's financial health changes? Is it worth taking the risk? Let's break it down in this video. At the core, government securities and SDLs are both debt instruments that are issued by the government to raise money. Government securities are issued by central government and SDLs are issued by state government. But both of them are auctioned and managed by RBI. Apart from that, government securities are highly tradable and that is why liquid. In case of SDL, even though they are tradable, their liquidity is low, which means at the time you have to exit, it can be a problem. The returns from both government securities and SDLs are taxable depending upon your holding period. Talking about their returns, then both of them offer similar returns, but the risk for SDL is slightly different. Let's understand that first. See, in the case of central government, they have the power to print money and collect taxes, which makes default on government securities nearly impossible. But in case of state government, they have to depend on their revenues from tax collection, central grants, market borrowings, etc. And the point is that not all the states have same financial health. Some have high market borrowings as well. Take Andhra Pradesh government for example. In 2018, the TDP government issued Amravati bonds so that they can construct a new capital state for themselves after their partition from Telangana. But in 2019, when YSR government came into power, they changed their priorities to something else other than those development for the new state. But in 2024, when TDP government again came into power, they resumed the work of Amravati. Now, in this case, the way the government kept changing, so did their priorities, and so did the credit rating of these bonds. Since 2018, CRISIL changed the rating of Amravati bonds as follows. From A+ stable to A+ negative to A negative to BBB+, and now in 2024 to BB+. Moreover, out of that 2,000 crore bond, 400 crore was returned to those farmers, but to make that payment, the government took additional loan from World Bank and ADB worth 13,500 crore, which further added to their debt borrowings. Whenever the credit rating changes, the yield fluctuates, and this kind of increases the risk perception in the minds of people because there is volatility in the price now in the secondary market, and all the investors can feel the heat of this volatility. To understand this better, let's understand whenever there is a change in the credit rating, how the bond price fluctuates and how the yield fluctuates because of that. Otherwise, calculating yield is complex, but we have simplified here to draw the point. When Amravati bonds were issued, their face value was 2 lakh rupees and their coupon rate was 10.32%. So their yield also came down to 10.32%. But when the credit rating downgraded the bond, in that case, their price in the secondary market rose to, let's assume, 2,15,000. Now, in this case, when you calculate the yield, that comes down to 9.6%. What it means basically is that now you are paying more money in order to get the same interest or that same coupon rate. Now, should investors worry? See, if you're holding for the long term, then these price volatilities should not affect you because anyway you are going to get the proper yield that was promised to you in the very beginning. But if you're someone who's buying from the secondary market and if the price is higher than the face value, then you might get a lower yield. This is why bond investors need to be mindful of credit ratings and market price fluctuations. If you are there for short term, then it can be stressful. But if you are there in the bond for the long term, then that can give you predictable returns. Now, if you are considering to invest in SDL, do evaluate these points. Number one is what is the state's financial health? Like what is their debt to GDP ratio? Number two is what is the market perception? And number three, if they are politically stable. Now, if you're wondering, has India ever defaulted on any of the government securities or SDLs? Then India has never defaulted, but there have been instances where other countries have defaulted on their sovereign debt. For example, Russia defaulted in 1998 due to their fiscal crisis and falling oil prices. Then Greece defaulted in 2010. Argentina defaulted twice in 2001 and 2014. And recently, Sri Lanka defaulted in the year 2022 because of the crisis which was happening within their country. Now, if you're wondering what will happen if ever a government security defaults, number one is that the investors will lose the confidence, the borrowing costs could rise up, a stock market crash could happen, and lastly, global perception changes which will be difficult to attract foreign capital. However, given India's monetary policy, robust foreign exchange reserve, and diversified economy, the default on government security seems highly unlikely. Now, who should opt for what? If you want the safest option, go for government securities. But if you're okay taking that slight risk, then you can opt for SDLs as well. I hope you like this video. See you in the next one. Till then, happy investing.